How is everyone doing on this Saturday night, July 25th, 2026? You are in the strategy room here with your host, Dr. Joe Berquist, and I've got another great show for everybody. I thank everyone for being here with me on this lovely Saturday night. But before we get into it, we got a lot of stuff going on. We got a big FOMC meeting coming up this week. And the big question everybody's asking is, will the Federal Reserve increase interest rates? Maybe yes, maybe no. I'm betting probably not, but you never know. Crazier things have happened in this world, right? Like, like the U.S. continuing to bomb Iran, right? And speaking of that, we've got a lot to talk about tonight in regards to that, in terms of oil prices, gas prices, treasury yields, bond yields, interest rates. We got a whole ton of stuff to cover with that. We're also going to take a look at some of the updated information on AI, data centers, what's going on with all that. I have some other banking related news for everyone tonight. As we get a little later, I've got a couple articles for the back end of the show tonight where we're going to talk about what are some of the structured debt that insurance companies have gotten into, and private equity. Private equity has kind of got what they're called like these zombie funds right now. So we're going to get into some of those things there on the back end. And then also last week I had talked about how President Trump had made basically this new, I don't know how to call it, a program on Truth Social. He had put in, basically made the ability that if a company wanted to buy and get basically early access to his tweets, that you could do that. Now, interestingly enough, a bunch of companies have already signed up for this service and are paying quite a healthy premium to get access to these tweets before everyone else. So again, we got all that to kind of get into. I got all the usual stuff tonight. I'm going to talk about all the episodes I put out this week. I put out 8 episodes this week. I had 3 bonus episodes, 5 regular episodes. So we'll get to all that. I've got bank news. I got economic indicators. I got all that good fun stuff for everybody here tonight. So, okay. Without further ado, let's jump into, as I always like to start with, I always like to take a look at the debt clock and see where we're at. Okay, we are sitting here at $39.6 trillion. We will cross the $40 trillion threshold in probably another 60 days, if not shorter, maybe even 45 days. But we are up to debt per citizen of $115,000 and a debt per taxpayer of $357,000. As I like to say each week, we've all got $357,000 just lying around, right? We can all just pay this tab. It's no big deal, right? Sure. The U.S. federal spending is currently at $7.2 trillion with an annual U.S. federal budget deficit of $1.6 trillion. We are sitting here at the federal debt to GDP is at 122%. You may have seen the consumer debt to GDP just crossed the 100% threshold. Now, these are very, very dangerous numbers. This means that what this is telling you is that our debt is way, way, way too high, and something needs to be done to seriously get this under control. I think one of my greatest disappointments with this new administration is that a greater effort has not been made to get this spending under control and try to at least get back somewhat closer to a balanced budget. I was such a fan, such an advocate for Doge, and I think in a certain respect, a very real way, Doge has been vindicated. For all those people kind of early on, after only like 3 or 4 months, that basically said, "Oh, well, Doge said they were going to find all this fraud, and and they're like, oh, where's it at? They were supposed to get a $1 trillion reduction, all this kind of stuff, whatever." And yet they found it. It took a little while, but it all came out. Minnesota, California, hundreds of billions of dollars in fraud every year, if not maybe even somewhere closer to $1 trillion. We don't know, but like I said, that one of my greatest disappointments is that this administration has not even attempted to put out a plan. It hasn't even been a discussion. And I said that a year and a half ago. I said one of the great shocks that is going to come out of this is basically Congress has no desire to cut spending, none, zero. That's a tragedy. That's a tragedy for all the future generations that are going to have to foot this bill. Because make no mistake, somebody will foot this bill one day. It's not. This is not. There's no free ride. There's no such thing as a free ride. Okay, someday it's going to be time to pay the piper. So anyway, all right. I mean, get off my soapbox, my friends. So a couple of other key numbers here. War defense spending still sitting at $944 billion, at least for the moment. That number is going to go up. Interest on the national debt, over $1 trillion, 1.043 trillion to be exact. Credit card debt is at $1.3 trillion, and that equates to a debt per cardholder of $8,333. So there you have it, some of the big key things there. One thing I do want to talk about, I'm not going to talk about it right now, but I probably will put together a little segment for next week, and that is money supply. Haven't really talked too much about the money supply in quite a while, but it is a very, very important thing. And it's one of the key tools that the Federal Reserve has in their toolbox for basically manipulating the flow of a lot of things in the economy. And that is by the control of the money supply, what they call the M2. So I will, like I said, I'll probably next week, I'll come back and talk about that a little bit more. So, okay. Let's get into some articles here, and I'm going to get into the usual stuff with interest rates and everything I'm going to kind of work my way into it for a second here. But first, I wanted to just hit a couple things real quick. So the first thing up, what to expect from next week's Fed decision. So the Federal Reserve is expected to keep interest rates unchanged at next week's meeting, but uncertainty remains about future hikes. Fed Chair Kevin Warsh's reduced market guidance increases the potential for surprises at the FOMC meetings. Inflation remains above the Fed's 2% target, but recent declines and energy price risks could influence future rate decisions. Now, yes, the inflation numbers did play nice for the month of June. However, everything that just unfolded in this last week. Let's see here. What do we get here? Boom. This is what unfolded here. U.S. strikes Iran as Trump vows retaliation for Americans killed. We had basically 8 straight days of the U.S. bombing Iran. And it appeared this afternoon that kind of put on hold a little bit. Okay. But, again, it's just the fact that the truce is out the window for the moment. The bombarding has started again, and as we'll see here in just a second, the gas prices, commodities, everything just shot up to the moon this week, which is not good. So even though inflation played nice, there is, make no mistake about it, there is going to be pressure on Kevin Warsh to increase interest rates. How much he increases, I don't know. Maybe just a quarter point or a half point, something like that. I'll say this, he would not do a half point at one meeting, but could he do a couple meetings in a row with a couple quarter point increases? Possibly. Here is the problem, though, and this is what history of economics has taught us. You have to ask yourself, what is the underlying reason for the increase in inflation right now? One of the main reason, the main driver, and I covered this last week, the main driver right now is what is known as a supply side shock. Okay, the attack of Iran on the fuel supplies, the gasoline supplies, that has created what's called a supply side shock. And in other words, what we saw was that the minute that peace deal was called, for about 2 weeks there, 2-3 weeks, everything started immediately coming right back down. And that's kind of the whole point. Like, in other words, if they were to next week, if they come to a peace agreement and this all ends, that's great. And then you would immediately see everything begin to kind of come back down. Now, would it come back down overnight? No, not overnight. It would take, it'd take a few weeks, probably 3-4 weeks, maybe even 2 months, a couple months for things to kind of come back to normal. But it would happen very quickly. So what the history of interest rates and dealing with this kind of thing tells us is that interest rate increases when it's a supply side shock doesn't really do much. It really doesn't have much of an effect. So therein lies the question. So therein, what do you do? Okay, if interest rate increases are not going to have much of effect in bringing down the interest rate when the underlying cause is a supply side shock, what do you do then? I mean, basically, I think the best thing they could do right now is to just stand pat, just sit still, don't do anything and just wait to see what happens. But we'll see. We'll see. Um, as markets gear up for next week's Federal Reserve meeting, the big question is whether Fed Chair Kevin Warsh may signal, even if indirectly, that interest rates are coming later this year. I would say no, given the fact that Mr. Warsh wants to get rid of what we called forward guidance. My guess is no, he will not give you a hint as to what he's going to do later this year. The Federal Open Markets Committee is expected to keep rates unchanged when it concludes its two-day meeting on Wednesday, but at least a couple of Fed officials are advocating for higher interest rates, and some investors see a small chance of a surprise hike. Yes, I don't see a hike this week. I really don't think that's going to happen. And again, if there are some investors out there see a small chance, maybe it's a 5% chance. It's not much of a chance. But here's the thing, like I said, at least a couple of Fed officials are advocating for higher interest rates. Yeah, Jerome Powell and his whole brigade over there. Yeah, they're all, believe me, they're all pressuring Kevin Warsh right now to increase interest rates. I promise you that is happening right this very minute, right this weekend. All right, so we'll see what happens there with the Fed this week. So now, just a quick economic indicator here. So unemployment claims plunge to the lowest level since 1969. Labor demand has slowed, with private sector hiring decelerating since firing on all cylinders this past spring. You know what? I got to make this a little bit bigger here so everybody can see that. There we go. I think that's a little bit better. So, weekly applications for unemployment benefits have fallen sharply to their lowest level in almost 60 years as the U.S. labor market remains steady. Initial jobless claims declined by 22,000 to 187,000 for the week ending on July 18th, according to new Department of Labor data released on July 23rd. Economists had forecast that the number of Americans filing jobless benefits applications would come in at approximately 212,000. This represents the lowest reading since April of 1969, the second time this year. The 4-week average, which strips out week-to-week volatility, also fell to a 9-week low of 207,500. Recent employment data reflects a solid labor market and continue to spotlight the low hire of the past 2 years. Businesses are neither terminating staff nor expanding payrolls at a substantial pace as they monitor the fallout from the artificial intelligence boom and determine whether the various headwinds will subside. The labor market is also moving into a different phase. David Miller, Senior Portfolio Manager and Chief Investment Officer at Catalyst Funds, said in a note emailed to the Epoch Times, "For now, the labor market remains supportive of growth, but it is no longer providing the same powerful tailwind it did over the last few years." For the second consecutive week, continuing jobless claims were below 1.8 million. Recurring claims, a measure of the number of individuals currently receiving unemployment benefits, has been trending higher since late April, but could be coming back down again. Economists use this metric to determine the challenges workers have in finding employment. It could also reflect more Americans exhausting their benefits since many states cap eligibility at 26 weeks. So there you go. So yeah, so again, I think this shows a couple of interesting things here. First of all, it kind of reaffirms to us that we do have, albeit a steady employment market, while it's, again, not setting the world on fire, but staying steady for the moment. Not really, again, nothing too crazy, nothing too bad, just in the middle, if you will. So that's good. But there is an interesting aspect here. The number of Americans that have potentially exhausted their benefits. That is an interesting aspect to this that I would like to see some more data there to basically tell us, like, yeah, how many people are basically just dropping off here. That would be a little bit more interesting to see if we could get that, or if I could find that somewhere. So like I said, I'll make a note of that. I'll keep that in the thoughts for next week. But anyway, moving on. Okay. So again, we started striking Iran this week. Everybody knows this. Everybody sees it in the news every day. I don't need to rehash it. We've been bombing them. And now, what was the effect ultimately that this had on everything this week? Well, a couple things. So oil tops $100 as Houthis claim strikes on Saudi tankers in the Red Sea. Threats to shipping through 2 major Middle Eastern waterways deepens concerns about disruptions to global energy supplies. And then we go to gas prices top $4 per gallon as U.S.-Iran conflict disrupts Hormuz shipping. Brent crude prices briefly climbed above $91 per barrel before retreating on renewed diplomatic hopes. So now we get into some of the actual numbers, as I like to go into here with everyone. So it was kind of a mixed week on Wall Street, kind of a choppy week on Wall Street. Stocks were mixed. But here was the big news here as we look at the bonds. I'm going to talk about the 30-year bond. I found a really, really good article on the 30-year bond that really gives a little bit more insight to that. Something I was definitely looking for the last couple months. Finally found it. I'm going to share that with everybody here in just a minute. But what happened to the 30-year bond? Well, we exploded over 5%, and we're now up to 5.163%. Big move on the long end of the yield curve, the 30-year bond. Again, not good. We really don't want to see this over 5%, and I will explain that in just a second when we get into that article. The 10-year Treasury, the main number that everybody looks at, as I've said 100 times, the 10-year Treasury is what drives all of the interest rates in your life, particularly on the consumer side of things. Your residential mortgage, credit card rates, student loans, auto loans, all driven from the 10-year Treasury note. And we saw that increase this week up to 4.687%, one of the highest it has been all year long. As a matter of fact, if we go back to the year, we can see here again, over the last year, when do we come close to this point? Was back in May. Yep, let's see, probably about May 29th or so. We were back here for the high for the year, but we are at a high for the year right now, basically touching about 4.7%. I mean, just not good. Not good. And then we see the 2-year note here has climbed up to 4.352%. All of your short-term bills, your 1-year T-bill up to 4.126%, the 6-month T-bill up to 4%, the 3-month is at 3.9, the 1 month is at 3.7. So pretty much everything across the board just going up here. Again, just not great. And then let's take a look at commodities for the minute. So the crude oil futures finished the week at $90 a barrel, with the Brent crude futures finishing the week at $92 a barrel. Actually, almost 93. It was 92.82. So approaching $93 a barrel. If this continues, if the bombing in Iran continues, there is no doubt we will see these Brent and crude oil future prices way back up over $100, just like we saw probably about a month and a half ago or 2 months ago, when basically oil prices were up to $112, $115 a barrel. Yes, we will see these unfortunately spike back up if this does not stop, and certainly if it escalates. If this escalates, yes, we'll see things more. Just to point out a couple things here, gold continues to fall. I mean, well off of its. I mean, gold was at an all-time high. Let me see if we have down here future stocks, calendars. Yeah, let's come back up here for a second. Yeah, I was trying to see if we could see the high there. Yeah, I mean, gold's all-time high. I think it got up to about 5,300 or so. If I think so, I mean, it's all the way down to 4,055. Which I mean, it was just a big drop from where it was earlier this year. I mean, even silver futures, silver was holding around $88, $80 to $88. It's now back down to $58. Natural gas futures were up over 3. They've come back down to 2.9. So just to point some of that out, let's look at crypto for a second here. Bitcoin has just been in the tank for most of the year, and basically is still hanging out around 64,340, literally half of what it was a year. If we look in a year ago, we were it was up at 125,000 in October of 25. It's the end of October there. It was up at almost 125,000 for a Bitcoin, and now it's down to 64,340. So literally cut in half. So all right, let's take a look at mortgage rates for a second here. So how did mortgage rates finish up this week? So according to the Zillow Lender Marketplace, the average 30-year fixed rate today, Friday, July 24th, is 6.455%, down 5.9 basis points since yesterday. The 15-year fixed loan is currently at 6.301%, 11.4 basis points higher than yesterday. The 5-1 ARM is 6.223, 11.3 basis points lower than it was on Thursday. And you know what? I'm going to try to see if I can make that a little bit bigger too. And then let's go down here. Let's take a look at rates here. So this, again, this is for current mortgage rates. Again, 30-year fixed is at 6.45%, 15-year fixed at 5.94%, the 5-1 ARM at 6.223%. The 30-year VA mortgage is 6.046%. So again, interest rates going the wrong way, coming back up higher. Again, the 30-year is about to get back to 6.5%. So definitely going the way that we did not want it to go. Current mortgage refinance rates. Again, 30-year fixed rate at 6.621%, 15-year fixed at 5.914%. The 5-1 ARM is at 6.491%, and the 30-year VA is at 5.946%. And that is on refinance rates. So that's where rates are at least on mortgage rates are at the moment. But again, we can see that they did spike up a little bit for the week. So again, not a great thing that we're seeing there. But let's take a look at a couple things here. So what the surging bond yields mean for consumers. So I saw this. Thought this was pretty good, so a sell-off in government bonds has pushed the 10-year Treasury yield to a 2026 high. We can see here yield on the 10-year Treasury note. As I told everybody, we're basically hovering around 4.7%. So renewed hostilities in the Middle East are driving a prolonged sell-off in U.S. government bonds, sending yields to new 18-month highs and lifting borrowing costs for businesses and consumers. The yield on the benchmark 10-year U.S. Treasury note, which helps set rates on mortgages and student loans alike, reached 4.71% in early trading Thursday, according to TradeWeb, its highest intraday level since January of 2025. With rebounding oil prices fueling inflation concerns, rising yields are already pushing up mortgage rates and undercutting the stock rally. Major indexes have mostly treaded water in recent weeks and were down sharply Thursday. And here's what's to know. So why are yields rising now? Well, Treasury yields are largely determined by investors' expectations for short-term interest rates set by the Federal Reserve. When investors expect those rates to go up, the relative appeal of Treasuries diminishes, causing their prices to fall and their yields rise to a competitive level again. The most immediate reason yields are rising is the resumption of fighting between the U.S. and Iran. The resulting rebound in oil prices has renewed worries about the inflation outlook and spurred a shift in interest rate expectations, as investors bet that the Fed will need to raise rates to bring inflation down. Still, yields have proven to be only loosely connected to oil prices in recent months. Before the breakdown in the U.S.-Iran ceasefire, oil prices had already retreated to February levels before the U.S. and Israel attacked Iran. Yields, meanwhile, remained well above their pre-war levels. One reason for that disconnect between the U.S.-Iran war, many investors had expected the Fed to lower interest rates this year to ensure the economy didn't slip into a recession. But as the war progressed, monthly job numbers were surprisingly encouraging. That seems to take rate cuts off the table even as oil prices subsided. Factors other than the Iran conflict have also kept inflation hotter than expected, including surging demand for artificial intelligence services. That has also supported the case for rate increases. So what are ultimately the effects here, though? Treasury yields influence borrowing costs across the economy, from the rates on new bonds issued by companies to the cost of taking out a mortgage. Yields on existing treasuries indicate that rates investors will demand when the government issues new bonds. And for all of its challenges, the U.S. government is still the most creditworthy borrower around, making its own borrowing costs a benchmark for what everybody else has to pay. Right now, rising borrowing costs appear to be an inconvenience to individual borrowers rather than a serious threat to economic growth. Even with the rise in yields, big tech companies have continued their historic borrowing spree to fund the construction of artificial intelligence data centers. Consumers have kept on spending on everything from auto parts to electronics. Now, I want everybody to think about this for a second. So big tech companies have continued their historic borrowing spree to fund the construction of artificial intelligence data centers. I want you to put a pin in that for a minute, because we will be coming back to that later in the show when we get into our AI conversation on data centers. Google had some very interesting earning results here this week, and they are cash flow negative for the first time in their history. And that's because of the spending on the AI data centers. And then the question is Wall Street starting to get tired here? And we're like I said, stay tuned. A little bit later in the show, we're gonna be going in. I've got 4 or 5 articles we're gonna go through on just that topic. So, but anyway, let's finish this for a second. Higher yields can also threaten stocks both by increasing borrowing costs for companies and giving investors an attractive alternative to riskier investments. Here again, the fallout has been modest, with stock indexes remaining close to all-time highs, but stocks have still underwhelmed of late, with the S&P 500 down 1.5% in recent trading Thursday afternoon, previously being roughly flat for the month. So, what happens next? That's the big question, right? Treasury yields typically rise and fall in an orderly fashion, but yields that rise too fast or become unmoored from economic fundamentals can spell trouble, which is why investors are keeping a close eye on the bond market right now. Some analysts have warned that if the 10-year Treasury yield broke through its previous 2026 high of 4.687%, its rise could accelerate while traders reach for a new equilibrium. Now, again, you could talk about different resistance levels. I would say I actually don't think it's that 4.687. I think the real number there is 5%. If it breaks over 5%, yes, you got that, because 5% is really, it's more than just it's a psychological barrier as much as the number represents the yield itself. So I think that if the 10-year yield does hit 5% and break through 5%, that's going to be a big problem. That is going to be a big problem, because it's going to begin to drive the cost of everything back up at a time when we really don't want it. Some analysts, or since the 08-09 financial crisis, the 10-year yield has only once reached 5%. And this is exactly what I'm talking about. Has only once reached 5% in October of 2023. Back then, its sharp rise dented stocks and sparked hand-wringing about the potential economic fallout. Fortunately for markets, the yield stayed above 5% only for part of a morning. With that round number leading to a surge of demand from investors, it was back below 4.9% by that afternoon and under 4% by the end of the year. So, yes. So again, I thought, again, great explanation there for what is happening. Again, things are going, but it's modest, right? We're seeing kind of a modest dent, if you will, at the moment. Like nothing majorly getting out of control. But again, this Iran conflict, again, it's very difficult to say in a certain respect. Like if we just go on and continue bombing, this is probably what we will continue to see. If, however, if it gets worse, and what I mean by worse is ground troops, an actual ground war, if that should come to pass, all bets are off, and these numbers could go through the roof overnight. If something like that were to if an escalation of that type were to happen. So again, it just so we're kind of um setting the stage, if you will, at the moment for what may or may not happen here shortly. And I mean in the next couple weeks. So all right, but let's take a look at this for a second. So this was a great article that I found on the long bond is making people nervous, and I wanted to get into this for a second. So because this was really good. Um, if they handed out medals for wrongness, I love this, for wrongness, a U.S. government report 25 years ago would have won a spot on the podium. Now keep it. They're really setting the context here. A government report from 25 years ago. Now, what could have been in that government report? What could it have said, right? Well, here's what it said. The Congressional Budget Office in January of 2001 predicted such large future budget surpluses that it said all redeemable U.S. government debt could be paid off within 5 years. That year, the Treasury Department stopped issuing its longest dated borrowings, 30-year bonds, because what was the point? Now, again, I have to go back. I have to read this again because I want the stupidity of this. I want the stupidity of this to sink in for a second, right? So they predicted that we were going to have such large future budget surpluses that it said that all redeemable US government debt could be paid off within 5 years. So we were going to make so much money that basically we could just pay the debt. We could pay the national debt off anytime we wanted. Really? Really? Um, Now, again, it's kind of crazy going back to I wish we had the debt level in that we had in 2001. Like in 2001, people thought the debt was high. Let's go back. Let's look at this way. Let's just go back to this for a second. The debt, the federal, look at this, the US federal debt to GDP in the year 2000 was 56.92%. And people thought it was high then. People thought, I remember that vividly. People were like, oh my gosh, the national debt's out of control. It's crazy. Look at this, 56. And now, why did they think 56 or 57? Why did they think that was high? They thought it was high because in 1980, just 20 years prior to that, it was down to 34.63%. It was we were a creditor nation, if you will. We were sitting there at a point in 1980 where we only had 34% federal debt to GDP. Like we were in a phenomenal place. And even in 2000, increasing that debt up to 56, about 57%, even there, while it was elevated, it was fine. It was okay. It wasn't catastrophic. We had options at that point. Now we're getting to the point here at 122% where we're running out of options. We're running out of options. We're getting to the point where the debt is going to start to eat us alive. Okay, that's where we're at now at this debt. But I mean, it's almost comical that they say here that we were going to have such large surpluses that we could just be able to pay that debt off anytime we wanted. So we didn't need the 30-year bond. Okay, so what happened? Treasury reverse course 5 years later. Okay, it's amazing it's amazing this charade went on for 5 years, but Treasury reverse course 5 years later as deficits instead widened. Oh, shocker! Yet those bonds remain an afterthought. They shouldn't be. Their real inflation-adjusted yield just hit its highest level since 2008. Again, going back to our rate chart here. Oh wait, it's got a little bit too big here, right? Let's bring this back into focus here. Let's go back to our bonds. And again, going back here to the 30-year bond. Like I said, this is our high. We've hit our highest rate since 2008. We're up to 5.163%. So coming back here now just for a second. And I'm going to make this just a little bit bigger here. The long bond isn't as closely followed as the 10-year note. The benchmark shown daily in this newsletter and important for things like mortgage rates. But it's in some ways more informative because its price is so sensitive to changing economic assumptions. The message it's sending lately isn't an encouraging one for Wall Street or for Washington. Bonds have something called duration. The weighted average time it takes to receive their cash flows. Stocks are similar, except those flows aren't known for sure in advance and stocks never mature. Today's hottest stocks have very long durations since they pay small or no dividends and dangle distant profits when they're expected to dominate AI or space or whatever. The upshot is that stocks' future cash flows can't be measured in isolation. They're compared with what you could earn risk-free from the government. Since long bonds have the closest duration to the S&P 500, their rising real yields raise the bar for stocks, all else being equal. That's why tech stocks sometimes sell off along with bond prices when there's a strong jobs report. Then there's what the 30-year bond yield is saying about Uncle Sam's finances. By themselves, they don't raise federal interest costs much since most debt issued these days is short term. They do reflect investors' creeping doubts about the government's future ability to pay, though. Let me say that again. What does the 30-year bond represent? They reflect investors' creeping doubts about the government's future ability to pay. It's unlikely that the US or other developed countries also facing stress will actually default, but there are other ways to deal with unsustainable borrowings. One is letting inflation quickly erode their value. Interesting. It's possible for governments to kick the can down the road for 4 or 10 years and hope the next people elected will make tough decisions. Not for 30 years, though. Investors' nervousness is actually understated since there are eager buyers for long term debt that help keep yields in check, pension funds, and insurers that need to match the durations of their liabilities with similar assets snap up the longest dated bonds, even when yields are absurdly low. 6 years ago, Australia sold a 100-year bond paying 0%. Distortions notwithstanding, long bonds are a useful litmus test for financial angst. Keep an eye on them. And then it says how to spend it, yield on each country's 30-year bond. And you can see here, just over again, this is going back to about 2021. You can see what is the pattern here that just jumps out at you. We have the UK, we have the US, we have France, we have Japan. And what is this chart showing us? This chart is showing you that the 30-year bonds are going up. And what is that? And like what we just read here. So, what is that an expression of? What is that telling us? That's telling us that people are getting very nervous. The debt levels have reached a point where people, investors, are getting very nervous about government's ability to repay this debt. Is basically that. Basically, that is, and that's why you should look at this. And it says, just as it said in this article, it's the sensitivity. You're looking at the sensitivity of that 30-year bond, so when it goes up, and especially now as it's broken through 5%, that's a bad thing. That's a bad thing that's a bad thing for the market. It's a bad thing for the economy. But again, I thought that this was great. I really love this. Was exactly the kind of article I was looking at to try to show a sharper explanation of that 30-year bond. Again, going back here for just a second. Again, showing that 30-year bond up to 5.61%. And looking at the 1 year here, we've kind of been, a little bit up and down here on the 30-year bond. It's been a little bit of a roller coaster here all year. I mean, we kind of started out the year pressing up on 5% and then came back down to 4.5%. And then, back up to 4.8 and then back down to 4.6. And then way back in May, we were pressing the 5% number again. Then came back down to about 4.8, and now we're again back up over 5% here. So definitely been a little bit of roller coaster, but again, just pointing out the significance of the 30-year bond and the sensitivity it has in the overall market. So, okay. All right, let's talk about this for just a second here. So something weird is happening beneath the stock market's surface. Now, this article talks a little bit about divergence. Look at how much traders are paying to hedge against big moves up or down in individual stocks, and a totally different picture emerges. That can be seen from a relative measure, what's called the VIXEQ, which is above 50. It's derived from a similar calculation for each stock in the index weighted by market value. Individual stock volatility is always higher, but the gap between the two just hit a record. Investors aren't bracing for some shocking development that would cause a market swoon, but they're unusually concerned about some specific stocks and sectors. According to Citadel Securities strategist Scott Rubner, mostly those are the momentum stocks like chip makers that have gyrated with waxing and waning AI optimism. A similar split can be seen in a much simpler measure. The divergence between market price and the breadth has never been higher. BTIG technical analyst Jonathan Krinsky wrote, according to a Monday note, there have been 52 trading days so far this year when the index went in one direction, but a majority of S&P 500 stocks went the other way. That now ties tumultuous 2,000 for the third highest number of instances this century. Since July isn't over yet, 2026 will almost certainly break the record. Instances were also high in 23 and 24 when tech stocks were the only game in town, but that has now changed. Much like the peak tech bubble year, serious doubts seem to have emerged about many stalwarts. Earlier this year, software stocks, once market darlings, became toxic as AI models coding capabilities spooked investors. More recently, chip stocks flipped within days from powering the market to entering their own bear trend. The Magnificent Seven are lagging too. An AI hyperscaler Oracle closed at a mid-year low on Monday. Divergence can be the hallmark of a rally when a new industry has taken the market baton, but also a preview of broader market trouble. BTIG's analysts write that as the relationship between stocks normalize, it's likely to be a result of everything catching down to the recent pullback in AI names rather than AI names catching up to everything else. So again, it's just something interesting I wanted to point out to everybody here. You know, the number of days when the S&P 500 price and the breadth moved in opposite directions. You know, again, we're up to, 52 days so far in 2026 that we're recognizing or realizing rather this phenomenon in the marketplace. So again, just something to keep an eye on, something to note, something to keep an eye on. Just as we are going to watch the 30-year Treasury, with its price sensitivity to the ability of governments to repay debt, we're going to keep an eye on this divergence, if you will, between the number of trading days, between the number of days that the S&P 500, the price and the breadth move in opposite directions, because it's a very telling thing. It's not one of those things where you look at it and you go, oh, okay, that is 100% correct all the time. No. But it gives you a very interesting insight into what is happening in the market per se. So, all right. So we've kind of covered that stuff. Now let's take a look at something here. So a little bit of bank news here for a second. I'm going to make this a little bit better. So one of the, and I'll go over this a little bit later, but I'll hit this now. One of the episodes I did this week was I covered the third and fourth bank failures of 2026. So here we have, U.S. bank failures rise in July as Kansas lender becomes the fourth bank to collapse in 2026. So the Federal Reserve gave Small Business Bank, that was the name of the bank, Small Business Bank, 30 days to recapitalize, find a buyer, or merge. But 18 days later, with none of those options secured, Kansas regulators shut it down on July 17th, making it the fourth U.S. bank failure of 2026 and the second in July. With the Lenexa, Kansas-based bank's failure, the 2026 tally now matches the total number of failures from the past 2 years combined and sits just one short of the 5 bank failures recorded in 2023. According to S&P Global Market. Collectively, the 4 banks that failed in 2026, Small Business Bank, Ketland Federal Savings and Loan Association, Community Bank and Trust West Georgia, and Metropolitan Capital Bank and Trust, held about $604 million in assets. That total is nearly 5 times the $126 million aggregate from 2025's failures, though still a fraction of the $5.98 billion tied to the 2024's 2 failures. It is also well below the roughly, insanely below the $552 billion linked to the 5 banks that collapsed in 2023, a year marked by the historic failures of Silicon Valley Bank, Signature Bank, and First Republic Bank. So, and then we have a great chart here showing U.S. bank failures since 2008. And you can see here, 2023 just sticks out because you had 2 of the largest bank failures in U.S. history with the failures of Silicon Valley Bank and Signature Bank, but $552+ billion in assets lost there in 2023. And again, so far here in 2026, just a fraction, if you will, of some of those bigger losses sustained in years past. So again, even though we had 4 banks fail, small banks, very small banks, but we've also had, one thing I pointed out is that we've had some very interesting stories with some of these bank failures. We've had fraud. We've had crypto scams. We've had embezzlement. We've had some very interesting things here. And even though these banks are small, they have provided us with some very entertaining stories. It's some very interesting stories. That is for sure. I do I do like my post-mortem on bank failures. I do. It's definitely one of the things I like to examine and look at. And the reason why is because hopefully there are great when you examine the failure of a bank, there are great lessons to be learned there. There are great lessons to be learned as to what to do, what not to do. So, all right. Let's move on here. Okay, let's get into tariffs for a second because there was a lot of tariff news this week. You know, the tariff news had calmed down there for probably about a month or so, but now all of a sudden it seems like the tariffs conversation is starting to heat back up again. So President Trump imposes tariffs on 60 trading partners over forced labor. The administration accused the trading partners of failing to enforce bans on forced labor. It comes as a global 10% tariff is set to expire. So the United States will impose new tariffs ranging between rates of 10% and 12.5% on more than 60 trading partners beginning on July 24th. The Trump administration announced on July 23rd. It comes as temporary 10% global levies are due to expire at midnight. The administration alleges that the 60 affected partners, which include the European Union, have failed to enforce bans on forced labor. It's the first major push by the White House to impose across the board tariff duties internationally since the Supreme Court ruled in February that President Donald Trump had exceeded his authority when he imposed previous global tariffs. Trump indicated after the decision that his administration would explore alternative routes to imposing international tariffs. Shortly after the ruling, Trump imposed 10% global levies by invoking Section 122 of the Trade Act of 1974, a section of the legislation related to balance of payments crises. It's these tariffs, which were limited by law to 150 days, that are set to expire at midnight, and the new tariffs are set to go into effect just as the old ones lapse. The new tariffs also rely on the Trade Act of 1974, this time invoking Section 301 of the legislation, a section related to forced labor. The tariffs would apply to nearly all U.S. imports, although many will be exempted, according to the administration. Exempted products include core essentials such as oil and gas, as well as fertilizer and food items. Items under Section 232 of the Trade Act, which governs national security tariffs on products such as cars, steel, aluminum, and copper, won't be subject to the new tariffs. Goods that comply with the U.S. Mexico-Canada agreement on trade will also be exempted. So again, very interesting here. We're going to also take a look at this. Forced labor tariffs hit 60 economies as Trump's global levies expired. Here's how much prices are expected to change. So the Trump administration has quickly rebuilt the wall of tariffs the Supreme Court knocked down in February, but consumers might not notice much difference. The new U.S. tariffs on goods from 60 economies took effect at 12:01 a.m. Friday, aimed at trading partners the administration says refused to block imports made with forced labor. These economies are the source of more than 99% of American imports. The tariffs went ahead just as President Donald Trump's temporary 10% global surcharge expired after 150 days as required by law. Yes, so again, interesting. So let me just go down here. So this is I'm gonna make this a little bit bigger here for a minute. Because this is kind of interesting here. So the 60 economies hit with the new U.S. forced labor tariff. So Section 301 duties of 10% or 12.5% take effect July 24th, replacing the Section 122 tariffs that expired the same day. So again, here you can see Canada 10%, Mexico 10%. Let's see here, Ecuador 10%, Peru 12.5%, Brazil 12.5%. Colombia 12.5. So anything in like the dark blue here is like 12.5. Let's see here. Argentina 10%. Let's go over here to Africa. So Algeria 12.5%. Morocco 12.5%. Libya 12.5%. You get the idea. France 10%. Spain 10%. England 10%, United Kingdom there, Sweden 10%, Finland 10%, Russia 12.5%, China 12.5%, Kazakhstan 12.5%, Australia 12.5%. So interesting. So again, just a very interesting chart here showing this. Just I thought was just good information to show on there. Now, the question becomes how small businesses can navigate the new round of tariffs. So let's see here. Let's make this a little bit bigger here. So small business owners should avoid rash decisions and diversify supplier networks strategically. 33% of small business owners faced significantly increased costs from tariffs last year. So small business owners facing a new round of tariffs should not panic. For better or for worse, the business environment we're in, this is just the new normal, said Gregory Stoller, a master lecturer on strategy and innovation at the Questrom School of Business at Boston University. This would be the worst time to throw the baby out with the bathwater. Stoller stressed that small business owners should not make rash decisions and should stick to their strengths to help weather what is simply a volatile period, whether it's tariffs, oil costs, or multiple conflicts across the globe, and that nothing will be resolved overnight. Small businesses will have to make decisions about how to adapt in the weeks to come after the Trump administration on Friday imposed sweeping tariffs targeting what it said was the use of forced labor. So, and then we kind of skip down here. The tariff affects 60 economies, which include both countries and regions or areas that operate as separate economic zones, such as Hong Kong. The agency said in the Federal Register final rule that the following 54 economies have failed to impose and effectively enforce the prohibition on the importation of goods produced with forced labor. And of course, it goes through all the names. And then somebody said here, basically, hold the line. Alex Sarek, procurement expert at spend management company Ivalua, said companies need to remain flexible and agile while it comes to their supply chain. That means reducing their dependence on individual countries and investing in more diverse supplier networks. Those who adapt without retreating from innovation will be the best positioned to weather the next wave of tariffs and the one after that. Small business expert Jackson Barnes, CEO of financial technology firm Novo, said they saw a 10% drop in customers sourcing goods from China suppliers and marketplaces over the last 2 years. The ones still importing are buying differently, Barnes said. They're placing larger and less frequent orders to consolidate shipments and spread out the cost of duties. So remember something, though. Remember, if you buy in the US, how much do you pay in tariffs? Zero. $0. If you buy in the US, you pay $0 in tariffs. So that is the point of all this, is to drive companies to buy more American made or products from American based companies. That's the point. That's the whole point. And if we don't have it, this should hopefully propel companies to begin to manufacture it. That again, that is the whole point. This is, you need the and here's what's going to happen. And I think the administration, and I think this is the part the administration has done a very bad job with messaging on, and that is that in order to go through this looking glass, if as it were, you're going to feel pain. Like, you're going to have pain in the short term. Why are you going to have pain? Well, because a lot of those goods and things that we're used to buying, they're over in where? They're in China, they're in Vietnam. Maybe some of the stuff is coming out of the UK or the European Union. Our supply chains have become so addicted to getting the product from those sources that our manufacturing base has been eroded here in America. And in order to reverse that trend, in order to get companies to start building here again, you're going to have to put some ridiculous tariffs out there. But you also have to remember that tariffs they're good and they're bad. They can be bad at the moment because they can potentially drive up some of the cost of getting these products. They can make it potentially a little bit more difficult to get some of these products, and that could cause a company problems. That's disruptions in your supply chain. The good side of it is that it could create jobs. It could create, again, if a company sits there and goes, hey, I can now compete because this tariff wait for it, this tariff is saving me from the cheap Chinese labor, the ultra cheap Chinese labor, and the ultra cheap Vietnamese labor, and the Cambodia labor, and the Taiwan labor. It's protecting me. That's what the tariff is doing. It's a protection. It's a barrier to protect U.S. companies. So now they go, okay, I could compete in that business again. I could compete in that industry again. I could start manufacturing that. And guess what the SBA is doing right now? Oh, wait, that's right. The SBA is offering you special loans for manufacturing products. So again, the incentives, albeit slowly, are being put back into place to try to bring some of this manufacturing back to our shores, bring some of these good paying jobs back to our shores. That's the point here. But in order to go through this, you are going to have to feel short-term pain. The problem, I think one of the biggest problems with this whole thing that we run into is that again, there's no guarantee that future administrations will continue this. And the Democrat administrations who will undoubtedly will not continue this. Like that, I think that is one of the biggest problems in place here. I think the hope is that by doing these tariffs, you start creating the jobs, people start seeing it working. And even some people there on the Democratic side basically say, wait a minute, this is working for me. I started this business, I'm making money again. So, you can't get rid of those tariffs because then my business will go away because it'll just go right back to China again. So hopefully you start to see some of that happens. The other side of it is hopefully the US starts making so much money, and we were making a lot of tariff money until the Supreme Court made what I thought was a really horrible decision. But the Supreme Court also they also kind of left the back door open, if you will, for Trump, because they basically said in their decision that we just don't like how you applied the tariffs. They didn't say the tariffs couldn't be done. They didn't say the tariffs couldn't be placed on. They just said, hey, we don't really like the way that you applied it in this situation under these kind of guidelines, if you will. But they said, hey, if you want to go back to what do we just say here? Let's go back to the Trade Act. Like it's like, yeah, there were 3 or 4 different laws that were already on the books related to trade and tariffs that the president could easily use. And that's exactly what he did here. He went right back and said, okay, I'm invoking Section 122 of the Trade Act of 1974 to put these tariffs in place. So, again, we could have, and here's the thing, we very likely will have another challenge to this going in, which will probably go right back to the Supreme Court yet again. However, the next time he's going to win. He's going to win because of what they said in that last ruling. But they basically said, yeah, like, listen, if the president uses one of these existing laws, it's fine. That's basically what they said in the ruling, and that's what he's doing here. So if this goes back to the Supreme Court again, he's going to win the next time. But that's neither here nor there nor the moment. The idea is around the execution of this and what is trying to be accomplished. And I do have, hang on a second. There's this book here. One of the episodes I put out this week was my summer reading list for 2026. This book right here, if I can come out of here for just a second, I want to show you this book right here, Reshore. This was on my 2026 summer reading list. Basically, how tariffs will bring our jobs home and revive the American dream, right here, Reshore. And this was written by Spencer Morrison. This book's, I guess, about a year and a half old. But I'm going to be doing a whole book report on this book because this book was phenomenal. It was phenomenally written. And again, hey, look, I can see there are arguments on both sides of this thing. There are arguments for tariffs and there's arguments against it. I July 4th episode I did on Adam Smith, and I talked about Adam Smith, talked about the wealth of nations. What was one of the big things that Adam Smith proposed or purported? It was to have free trade, but I have always contended that we don't have free trade. When the U.S. The free trade is great if both sides, it takes 2 to tango. Both sides have to be willing to do the same thing, right? Like if the U.S. goes, listen, we'll trade with you and we're not going to charge you any tariff, right? No tariff, nothing like that, right? So if we do that, you know what I expect? I expect reciprocity. I expect them to come back and basically say, you know what? That was great. Thank you so much for not charging us a tariff. So when we trade with you, we're not going to charge you a tariff either. That is free trade. When both countries are doing a fair exchange of goods. But that is not what we have gotten. That is not what we've gotten. It's been the US giving it away to other people and them hammering us with their tariffs. And it's, I mean, look at Canada. Canada bludgeons us with tariffs. They bludgeon us with tariffs, but you don't hear that, and this is part of the problem. You don't hear that side of the argument. All you hear is people say, "Oh, well, this is ridiculous. He's killing free trade. He's killing free trade." And what they always neglect to say is that you're killing a bad deal. You're killing a raw bad deal that the US has been getting for decades on bad trade agreements, bad trade deals, where everybody else is allowed to kill us all day long with their tariffs, but we're not allowed to tariff them. And that's the part that you have to understand and then once you understand that, like, yeah, this isn't a fair fight. This is like us with, we got one hand tied behind our back, hopping on one leg, and the US is getting completely beat up in the international trade scene. We're getting beat up by China, by the European Union, by everybody. And President Trump basically said, no, 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 no. I'm going to put these tariffs out. If you're going to tariff me, I'm going to tariff you. And I'm going to put these tariffs out there. And furthermore, we're going to use these tariffs to try to bring jobs back to America. That's great. What they have failed to do, though, is in the messaging. The messaging has not been great. Like they have not explained to people that, like, hey, there's going to be some pain here in the short term. There's going to be some pain. Like when we try to go through this to try to bring these jobs back to the US, yeah, there's going to be some pain there until we could start to get companies, reinvesting, new startups coming in, companies reinvesting, companies picking up some of these product lines that they had let go or haven't been in for a long time. That's going to take some time to get through all that and get all that going. And there's going to be some pain there, but it's also like, hey, we got to protect this. And I think that what would really be great if they started showcasing some of the wins. They really started showcasing the wins here. A big part of the problem with this whole conversation has in fact been the media, because the business media in particular, like CNBC and Bloomberg and everybody, they don't report on what the reality is. They always give you this, oh, it's free. They always, like I said, they always give you that this is free trade. The US has free trade with these countries, and that's it. That's all they tell you. That's all they tell you. They give you that line. Oh, well, this is killing free trade because we had free trade with these other countries. Okay, where's the rest of it? Where's the other half of that equation when you go, yeah, but were those countries charging us tariffs? Oh, yeah, because the minute you ask that question, then they have to tell the truth. Then they have to say, oh, yeah, that's right. Yeah, they were tariffing the crap out of us for decades. And it's like, okay, so wait a minute. So that wasn't really free trade, and we weren't really getting a fair deal. And then all of a sudden it's like, oh, and then the conversation changes very quickly. Then it's like, oh, hey, let's talk about something else. But like I said, the messaging around this needs to be better. If I could give one piece of advice to the White House, it would be, hey, I would be every single week, I'd be trying to highlight successes, success with this. Let's bring a company to the White House and say, hey, how have the tariffs helped you? Did you start this company? Is this industry more competitive now? Get U.S. Steel up there. Let U.S. Steel talk about how great the tariffs have been for them. Like I said, just get people in there to talk about how great this is, and show the money. Again, we did a great job of showing the money that came in. Now there was, like, I don't know, 160 billion that had to be refunded, but okay, that's done now. Now we've got new tariffs coming in. We'll have more money rolling in. Let's see those numbers. Show those numbers over the next 6 months. Let's see those numbers. So that would be my one piece of advice there for the administration. For who knows, I doubt anybody. I doubt they're watching this. But yeah, who knows, right? What do I know, right? What do I know? I'm just some little podcaster on YouTube. What do I know? All right. let's continue on tariffs. Okay, a couple other big tariff announcements here so we can wrap up the tariff conversation. So, President Trump announces 100% tariff on generic drugs in 2028, rising to 200% in 2029. The tariff is intended to encourage the reshore of America's pharmaceutical supply chain and protect national security. Yes. So, one of the biggest things that came out of COVID, one of the biggest things that just hit us over the head, like it was the fact that all it was like the supply chains, the pharmaceutical supply chains. It's like we can't make Tylenol, we can't make morphine, we can't make just like basic stuff that we need every single day for people to survive. We don't, yeah, we can't make it. Like that was one of the big realizations of COVID, was that, yeah, this is a major problem and we've got to get this stuff back. What's the big, let me ask everybody a question here, question time here. What's the big realization right now? It's called rare earth minerals and materials. What's big about that? We can't make magnets. Think about that. We can't make magnets. Why do you need magnets? Oh, you need magnets for all kinds of things. Building all kinds of military weaponry. Yes. Oh, yes. Need lots of magnets for that. Yeah. And you know who controls all the rare earths right now? Oh, that's right, China. Yeah, China controls a ton of rare earths. What's another reason? Do we have rare earths in America? We do. We do have a bunch of rare earths in America. Why can't we get to it? Oh, well, because we have this little thing called the EPA. And the EPA basically is, you know, those lovely folks over there basically just shut everything and everything down and make it impossible for us to get some of these very critical things that we need. Because we're saving Mother Earth every 5 minutes, right? The stormwater runoff of my house is saving the earth. But again, this is getting back to this for a second. But again, this is critically important. Get our pharmaceutical supply chain back in America, because again, it's not a matter of the drug companies. It is a matter of national security, and it's great that he put this tariff on here. But I think this needs to go farther than that. There should be a law that addresses this. There should be a law that basically stipulates to all the pharma companies, and not even pharma, but just any industry out there, that basically we would rely or would absolutely need that product or that thing in a moment of crisis, like a financial crisis or a pandemic or whatever. That if you're in that business and you sell that product you have to be able to supply it here in America. You've got to be able to supply it to America, and that should be a law, not an executive order, not a tariff. That stuff is nice, it helps, but that should be a law that basically these companies so that this does not happen again. Anyway, all right. So they're going on here. So then Trump imposes 50% tariff on certain Canadian goods. The new tariffs will take effect in 30 days. Yes. And then U.S. President Donald Trump imposed an additional 50% tariff on some Canadian goods on July 20th, saying that the country has discriminated against American dairy, alcohol, and auto exports. Yes, they have. President Trump is taking action to hold Canada accountable for its continued discrimination against and unreasonable and unequal treatment of U.S. commerce that has burdened and disadvantaged hardworking Americans, the White House said in a statement. The tariffs will take effect in 30 days. Now, very interesting. One thing I forgot tonight that I did want to show everybody was that the number of Canadian companies that are moving to the United States is incredible. It's incredible. And a big reason for that is because of the tariffs that have been imposed on Canada. So they are moving their operations. They're moving their operations into the US so they can make the goods here. Again, this gets back to, this is going to be one of the big success stories of bringing new jobs here to America, bringing supply chains back to America. But they got to highlight this. The Republicans got to highlight this. The Trump administration has to highlight this. The problem is that, that's what I said. The problem is a lot of people are not aware of this. They're not aware of what's going on here. So, all right, now we move on for a second here. All right, so And this is kind of, it's not really part of the tariff thing, but this was kind of a side effect, if you will. So the EU fines Google $1 billion over search and app store practices. So EU officials ordered Google to stop favoring its own services and ease Google Play restrictions. Now, after the EU fined Google this $1 billion, then we had this response. So Trump orders investigation into EU treatment of American tech companies. Billions of dollars in fines against American technology companies must be reversed, the president said. So President Donald Trump says his administration will open a formal investigation into the European Union's trade practices, threatening new tariffs over billions of dollars in fines levied against U.S. tech companies. In a Truth Social post on Friday, Trump said the investigation would begin immediately under Section 301 of the Trade Act of 1974. Notice what he's doing there again. He's going through an existing law, the existing Trade Act, once again, of 1974, which allows the president to protect U.S. businesses against unfair trade practices with tariffs and sanctions. He accused the EU of robbing U.S. companies and, in turn, American taxpayers. He's not wrong. He's not wrong. Now, again, why would he do this under this act, Trade Act of 1974? Well, they're finally starting to get hip to the game. They're waiting for the judges to come in, or they're waiting for the lawsuits to fly, okay, to basically say, oh, you can't do that. In which case they're going to say, we did it here. The precedent has been established. The law has been established. I absolutely have the authority and right to do this under this law. And if you don't like it, go back to Congress and tell them to change it. Okay. And so therefore that is called win, win, win. So again, you see they're finally starting to smarten up a little bit on some of this stuff. But again, we'll see what happens with that. Now, it's kind of a this is kind of a catch-22 situation, right? Because Trump, he has to stand up for the tech bros here, because because the problem here is if you let them get away with this treatment of the tech bros, they'll do it to other industries and other companies as well, right? So it's kind of like if you got to step up, you got to stand up for one and all, right? You can't just pick and choose. Problem is, I hope he's going back to the tech bros and basically saying like, yeah, guys, what are you doing for me? Okay, I'm standing out here. Okay, I'm bringing the shield. Okay, I'm going to shield you guys from this. I'm going to protect you guys from all this abuse. What are you doing for me? What are you doing for the American people? That's a question I would love to hear them answer. I would love to hear them answer that. Yeah, Mark Zuckerberg, all these clowns. What are you doing for us? That'd be a great question to ask, right? Okay, now. All right, we're going to get back. We're going to come back to the AI. Like I said, I have a bunch of articles here on the AI conversation. We're going to come back to that in a minute. But before we get to that, I'm going to switch gears. This is the time of the evening where I like to give you guys the economic indicators. I love to give you guys some bank news, and I like to just run through the episodes that I put out for this week. So let's get in, as I've got up there on the screen, let's get into the economic indicators here for this week coming up. And we got on Monday, July 27th, we got durable goods orders, the 2-year note auction, the 5-year note auction. On Tuesday, July 28th, we have the ADP Employment Change Weekly, the Goods Trade Balance, Atlanta Fed GDP Now for the second quarter. CB Consumer Confidence, the 7-year note auction, the API Weekly Crude Oil Stock. On Wednesday, July 29th, we have the FOMC statement at 2 p.m., FOMC interest rate decision at 2 p.m., and then the FOMC press conference at 2:30. On Thursday, July 30th, initial jobless claims, continuing jobless claims, core PCE price index for June, the PCE price index for June, personal spending for June, the GDP quarter over quarter for the second quarter. And then finally, on Friday, July 31st, we have employment cost index for the second quarter, Chicago PMI for July, the Michigan consumer sentiment for July, and the U.S. Baker Hughes total rig count. So again, tons of economic data coming out this week. Obviously, all eyes will be on the FOMC meeting on Wednesday and whether or not they do or do not raise interest rates. And finally, everybody, I will personally personally will be keeping a close eye on those note auctions, the 2, the 5, and the 7-year note auctions. I will be really interested to see how well they go and what happens there with that. So, all right, well, those are your economic indicators for this week. And let's take a look at some bank news, shall we? Let's get in this for a second. Hang on, I just need some water for just a second. Okay. All right. So what do we got here this week? So consumer sentiment was up in early July. Industrial production edges up on mining utilities. Housing starts did jump in June. Let's see here. Credit applications increase in June. So application rates for credit over the past 12 months increased in June due to the highest level since October of 2021, according to the Federal Reserve Bank of New York. So that's good. It's good news. FDIC details Genius Act information and collection proposal. So the FDIC published new information on its recent proposed rule to implement requirements under the Genius Act. So the FDIC on April 10th proposed a rule that includes weekly and quarterly reporting forms that must be completed by FDIC supervised permitted payment stablecoin issuers. The new financial institution letter provides notice of the forms and instructions in support of the proposal. Article details stablecoins' possible effects on community lending. So, with the Senate working to bring the Clarity Act digital assets bill to a vote as soon as this week, a new article explores the effects that rewards-based stablecoins could have on community bank lending. So, in the Business Alabama article, Alabama Bankers Association President Scott Latham says that if significant local deposits move to the stablecoin environment, the capacity for the banks to loan money out to you and me, or the hardware store, or the farmer, or the first-time home buyer begins to shrink. So I have covered a lot of this talk about stablecoins and the Clarity Act. I have a lot more to come in the very near future. I'm basically working on a whole crypto week, if you will, and all that. So yes, there is a lot of truth to what he's saying there. However, I would put a but on that because a lot of it depends on what do you ultimately do with the stablecoin? Like, do you use it as collateral? Like, if you can use it for collateral for lending, or if somehow maybe the accounting treatment gets altered down the road, that could change it all back to like where if a stable coin is someday actually counted for like a deposit is counted for on the balance sheet, then that could change the games. You also have what's called digital tokens. A digital token actually can be treated just like a regular deposit on a bank's balance sheet. So if banks end up leaning more into digital tokens as opposed to stablecoin, that could be a lot better because right now that digital token is treated as like it's like a dollar on like a dollar deposit, and that could be used to support. Yeah, that could be used as collateral for loans and things of that nature. So, so we'll see. We'll see. We'll talk. Like I said, we'll continue that conversation. Keep moving on with that. House passes ICBA supported regulatory relief bill. So the House of Representatives passed the Main Street Capital Access Act. ICBA advocated legislation to provide regulatory relief targeted to community banks on a bipartisan vote of 270 to 155. So that will now move to the Senate, and we'll see what happens with that. Interactive map shows effects of stablecoins on local lending. As Congress continues to debate the Clarity Act, a new interactive map from the ICBA details how stablecoin growth could put small business credit at risk. For each state, the interactive map shows the number of small businesses that could lose credit, share of small businesses at risk, and small business lending capacity at risk. Now, I don't know, but there might be, just hint, hint, there might be an episode showing that map coming up real soon. Just saying, just saying, just saying. FinCEN director, fighting fraud, modernizing the BSA are top priorities. So Financial Crimes Enforcement Network director Andrea Gacki said the agency's top priorities are protecting Americans from fraud and modernizing the Bank Secrecy Act regime. So Treasury stops payments to deceased individuals. So the Treasury Department announced It has implemented a government-wide payment verification process that helps stop federal payments from being sent to deceased individuals, fulfilling a key requirement of President Donald Trump's Protecting America's Bank Account Against Fraud, Waste, and Abuse executive order. They were able to stop over $100 million in basically payments to deceased people. $100 million. And I just ask, why was that not done? Like, I don't know, decades ago? Like, just wild. ICBA, a new version of digital assets bill needs to be strengthened. So here we go. More on the Clarity Act. ICBA and other groups said the latest version of the Digital Asset Market Clarity Act still puts at risk the local lending that drives economic activity in the U.S. So yes, so I actually have more on that in just a second. Acquisition fuels ICBA push to change to credit union tax policy. So a new community bank acquisition by an out-of-state bank tax-exempt credit union has put the credit union tax exemption back into the spotlight. So yes, I'm sure that conversation will continue. ICBA pushes for pushes for proportional AI framework. So ICBA said responsible AI adoption must enable financial institutions to capture the benefits of innovation while managing risk, and any framework should be proportional to the size of the bank. So, so basically, this was in a letter responding to the Financial Stability Board's Sound Practices for Responsible Adoption of Artificial Intelligence report. House panel releases report on combating fraud. So the House Financial Services Committee released a policy framework for combating the rise of financial fraud and scams that cites ICBA resources. Lawmakers urge the Fed to streamline the M&A process. So members of the House of Representatives encourage the Federal Reserve to continue improving the efficiency of bank merger and acquisition application reviews. GAO, that is the Government Accountability Office. They report flags 15 duplicative cyber incident regulations for banks. A new report from the Government Accountability Office shows the banking industry must comply with 15 duplicative cyber incident reporting requirements. So hopefully they will eliminate all, if not most of those. ICBA and others issue best practices for sharing sensitive information. So ICBA and other groups published a new paper recommending best practices for safeguarding sensitive information in the supervisory process. So yes, okay, that is good information there. Now, one thing I just wanted to find on the Clarity Act. Okay. So this was from, I believe, Thursday. So Senate Republicans released the latest near final version of the Clarity Act, but a key ethics agreement between Republicans and the White House still does not meet what Senate Democrats, especially Senator Ruben Gallego and Senator Angela Alsobrooks, have said they require, leaving the bill's prospects uncertain with the August recess approaching. So now, so our lovely Congress and Senate decided to roll out for 6 weeks. 6 weeks, man, in the middle of the summer, just rolling out for 6 weeks. Does that tell you that is anything going to get done for basically the rest of the year? No, not really. Because they're gonna come back in September, and the minute they come back in September, they're immediately going to say, "Oh, you know what? The election is just like 6 weeks away. Can't really do anything. We got to just shut it down. Wait to see what happens with the election." And then, of course, if the election happens, if it goes their way, then they'll say, "Oh, yeah, you know what? We got to wait to, that election was so hard. It was so grueling and brutal. Sitting around on election night was just really difficult." And, so we're just not going to be able to get back to it until January. We're going to have to wait till January till everybody's sworn back in, and then we'll get back to it. Now, if the Republicans lose and the Democrats win, then the Republicans will have basically a lame duck session, if you will, to try to get a bunch of things done real quick, as they always do. How much will they get done? What will they even try to get done? Probably not much anything. They haven't done much anything the last 2 years. I wouldn't expect them to do much of anything in a lame duck session. So it'll be. It'll be the usual, the usual. Yeah, you got to vote us. We got to vote us back in so we can do something again. Yeah, or nothing. Anyway, all right. Enough with the politics. Enough with the politics. Let's get back to. All right. So let me run over here real quick. What episodes did I have out this week? So I put out 3 bonus episodes, and then I put out 5 regular episodes this week. So the bonus episodes, so I put in BND Strategy Room bonus, a summer reading list. So I just put out my summer reading list for 2025. And the books, I had 7 books on the list. I had Suicidal Empathy, number 1. Number 2 was Reshore, what I showed you a little earlier. Number 3 was The Repo Market, Shorts, Shortages, and Squeezes. Number 5 was Crisis and Leviathan, Critical Episodes in the Growth of American Government. Number 5 was The Banker Who Made America, Thomas Willing and the Rise of the American Financial Aristocracy. Number 6 was Steve Jobs in Exile, The Untold Story of Next and the Remaking of an American Visionary. And then number 7, the last one, was the book 1873, The Rothschilds, The First Great Depression, and the Making of the Modern World. So I thought that was a really good book list. I'm going to be doing book reviews on Suicidal Empathy and Reshore. Those will be coming very soon, in the next week or so. And then I will be covering a few of these other books thereafter. So, and then the other bonus episodes I put up was just checking up on the American consumer. Again, just content from last week's live stream. And then I also did Is the Music About to Stop for the AI Bubble? Again, continuing that AI conversation from last week. So those were the 3 bonus episodes that I put out. And then as far as the 5 regular episodes for this week. So the first one I did was on Monday, and that was third and fourth bank failures of 2026 as regulators close banks in Indiana and Kansas. So, Ketland Federal Savings Loan Association, located in Ketland, Indiana, and Small Business Bank, located in Lenexa, Kansas, are the third and fourth bank failures of 2026. KFS was closed on Friday, July 10th by the OCC after its capital position became critically undercapitalized. KFS had a very tiny 3.73 million in assets at the time of its closing. Nearby but unrelated, Ketland Bank was appointed receiver by the FDIC. Now, SBB, Small Business Bank, was closed on Friday, July 17th by Kansas state regulators after the bank was deemed to be significantly undercapitalized. SBB had 73 million in assets at the time of its closing. The Farmers State Bank agreed to assume all of SBB's deposits and purchase some of its assets, according to the FDIC, who is acting as receiver. So again, just some information there on those 2 bank failures from last week. Then I did a couple of just bank news episodes. One was kind of a catch up for a pile of stuff that I just had out there. So I did on Tuesday and Wednesday, I did a couple of bank news episodes. And then on Thursday, I covered the brand new Texas Stock Exchange. So the Texas Stock Exchange is ready for takeoff. The Texas Stock Exchange is the TXSE, also known as the TexE. Is gearing up to start trading with big IPOs getting ready to come to market. The TexE might be opening at just the right time. So if you want again, good coverage there on that topic. And then on Friday, I had a series of articles on deposits, cost of funding, funding pressures, if you will, and how that could play into banks' margins. So I asked the question, will increasing funding costs squeeze bank deposits? So market expectations now favor increasing interest rates, and thus expectations around deposit cost pressures have changed. Many banks were hoping for continued rate decreases to continue relieving funding cost pressures, with the market now expecting the Federal Reserve to increase the federal funds rate in the second half of 2026. This means that funding costs will stay flat for the moment and then rise with both rate increases and competitive pressures. If rates increase, that means that loan rates will increase, and thus banks should be able to maintain that interest margin. However, If loan demand decreases due to that said increased interest rates, i.e., loans become less affordable, then margins could compress with higher funding costs. So again, just an interesting topic I wanted to cover. And again, that's one of those episodes that could really set the stage for later this year. Like if we do get a couple of rate increases, and if we do see loan demand begin to waver a little bit, or we begin to see bank funding costs go up, which in other words, i.e., what they have to pay out on deposits, if that goes up and we start to see some margin compression, this will be one of those episodes I refer back to later in the year to say, see, like this is why I did that episode. All right, so those were the eight. That was the 8 episodes that I put out this week. Can't wait. Got a bunch of, I think, really good stuff coming up for this week coming out. I have all new episodes again this week, so we'll get into a lot of that. But that is the good stuff there for this week. So now let's jump back into our AI conversation here. So I got a bunch of things here to roll through with everybody as we start to come into what will probably be our final half hour here on the live stream. But let's dive into this. So a couple things happened this week. So Trump expands plan to keep the AI data centers from increasing household energy bills, right? Sounds good. White House Press Secretary Caroline Leavitt said on July 23rd that nearly 200 additional stakeholders had signed on since March. So President Donald Trump on July 23rd announced an expansion of his administration's previous energy infrastructure build-out pledge aimed at preventing the construction of artificial intelligence data centers from increasing Americans' home energy bills. Trump first unveiled the Ratepayer Protection Pledge in March, which brought together tech titans, including Amazon, Google, Microsoft, Meta, OpenAI, Oracle, and xAI under a voluntary and non-binding pledge to compel companies building data centers to front the cost for new energy generation and grid infrastructure. So again, and I keep saying this, this is it's a voluntary non-binding pledge. Like this doesn't mean anything at the end of the day. It looks great for PR. It looks great for PR because then the tech bros run back and are like, see, yeah, well, look at this, we're good guys, we're gonna pay for all the energy that we're using or whatever. Like, okay, yeah, all right, we'll see. So far, I would say that this has not been the case. Go ask some of those people down south. Go ask some of the people in Georgia right now how well this is working for them. It's not working very well. So I like I said, I'm very highly skeptical of this. I think that this makes for great PR, but I also think that there's no teeth in this at all. And I think that the tech pros here they'll play along. They'll say, oh yeah, sure, we're going to do this or whatever, but my money is still on the fact that the American consumer and taxpayer is going to get stuck with this bill at the end of the day. But we'll see. This is one of those times where I hope I'm wrong. I hope I'm completely dead wrong, and I hope that the tech pros pony up and pay their chunk of it, and that we do not see massive rate increases on energy bills. So, all right, now 890 billion tech wipeout puts focus on runaway AI spending. So concerns about artificial intelligence spending hit the market value of the Magnificent Seven hard on Thursday. Now they did rebound a little bit on Friday, but this gets to the very heart of what I've been talking about for the last few months. I mean, the technology spend it's completely out of control. I mean, there's no way that tech spend can be maintained. It's not realistic. And last week I talked about the amount of bonds that were being floated to the tech spend. I showed like the amount of Oracle is planning on spending on AI. I mean, it is crazy. So let's get into this. So Wall Street is reckoning with a new reality. The biggest tech companies are no longer cash printing machines. Concerns about Alphabet's and Tesla's earnings results spread to other major tech stocks on Thursday, with investors dialed in to the implications of ramped up capital spending, putting a dent in the artificial intelligence trade. Alphabet's shares slumped some 7%, costing the company more than $293 billion in market value. Its largest one-day market cap loss on record. Shares of Tesla tumbled 15%, the stock's worst post-earnings performance ever. The sell-off extended to other tech stocks. Meta Platforms fell 3.4% and Oracle slid 4.6%. The Magnificent Seven erased nearly $890 billion in market value, the biggest one-day market cap decline since the tariff turmoil of April of 2025. The Nasdaq Composite lost 2.2%. Both Alphabet and Tesla reported soaring revenue, but investors instead zeroed in on their AI spending. The phrase of the day, free cash flow, which turned negative at both companies. Look at this. So here's Alphabet's free cash flow. They're just, like I said, they're, what did it say up here? They're cash printing machines. But again, just looking at this chart here, look at this. I mean, Google going back, they have never in their entire history of the company, they've never had a negative year of negative free cash flow. Look at this. First time ever. Boom. Look at that negative free cash flow right there. Alphabet's free cash flow came in at negative 5.9 billion. The first negative print since the company went public in 2004. Its finance chief said free cash flow would remain under pressure as the company deepens its investments in AI. Alphabet also lifted its capital spending forecast to as much as $205 billion this year. Meanwhile, Tesla is spending big on its pivot toward autonomous vehicles and robotics. That includes building a chip manufacturing facility called Terafab, which Tesla is developing in partnership with Intel and Elon Musk's rocket company SpaceX. Meta Platforms is projected to report negative free cash flow when it releases second quarter results next week, according to analysts surveyed by FactSet. Analysts expect the same from Amazon.com, which also reports next week and already saw its free cash flow dip into the red in the first quarter. So again, this is not good. This is not good. Like I said, these companies are good. Their spending is going to get reined in because their stock prices are going to start to pay the price for this. And what is also going to happen is these data centers, okay, there's major pushback on the data centers right now. And I'm not saying that a lot of these data centers won't get built. They probably still will, but if anything, they're slowed. They are going to get dramatically slowed in their progress and being able to break ground, getting to a point to break ground and then building the thing and getting it done. I think that at best right now, they're going to get majorly slowed down in the development of these data centers. So that's slowing down. I think the hurting of the stock price, the negative free cash flow, the absurd spending that they want to do the next 3, 4, 5 years into the future. I think that their stock prices are going to suffer. I think there's a chance that the AI trade could blow up, the AI bubble, if you will, and that will put pressure on these guys to come back to reality. But let's look at a couple, because you got to look at all this stuff together, right? So let's look at a couple of, you'll get a clearer picture at the end here in a minute. So let's go in here for a second. So AI insiders warn of hyperscaling risks. AI utility is being fluffed up to justify its progression, a policy and safety expert said. So major technology firms are investing billions of dollars in new data center facilities, power supplies, and computing resources. Industry insiders, however, are divided over whether artificial intelligence is worth the cost. The five biggest cloud and AI infrastructure providers in the United States, Alphabet, Amazon, Meta, Microsoft, and Oracle, have committed to spending almost $700 billion combined on AI capital expenditures just this year. That's going to go into the trillions of dollars in the years to come. AI computational resources, or compute, are a primary driver of the technology's growing resource footprint. This includes things such as memory, processing power, and specialized hardware. Many AI models run on cloud computing, most of which is provided by one of three tech giants: Amazon Web Services, Microsoft Azure, and Google Cloud Platform. According to Usage AI, those three companies alone represent around 68% of total global cloud compute spending, giving rise to the term hyperscalers. Hyperscale facilities come with significantly higher resource demands, and there are an estimated 670 of these facilities planned in 2026. Yes, and these are not, and look at this picture here. Look at this picture. This is not your grandfather's data center. These are not the little, this is not the little thing. These are multi-million square foot, massive, massive data centers. And they want to put hundreds of these things around the United States. I actually covered an article probably maybe like a month or so ago. I covered, it had a great chart, covered all of just the number of data centers. The United States has by far and away more data centers than anyone else around the world combined. I think we have almost 3,000 data centers with another 1,800 in the works. So if all those get built, I mean, we'll have like 4,600 data centers, and we'll have data centers all over the place, coming out the wazoo, if you will. So anyway, all right. So they want to build these data centers basically, so the engineers and architects actually building these systems are the ones asking the hard questions about compute, model redundancy, and whether the infrastructure footprint is proportional to the value being delivered. Yeah, I think that's some great questions there. Water and power demands are accelerating alongside AI's growing footprint. Electricity price spikes between 2025 and 2026 have been observed in multiple states amidst the rush to build more data centers to support AI. The U.S. Energy Information Administration found these facilities account for roughly 55% of U.S. electricity demand growth. So, yes, no doubt. In Virginia alone, Virginia has what they call Data Center Alley in Virginia, which is it's amazing. The growing AI footprint has prompted some industry insiders to pause and consider the true cost of rapid development. Yeah, I would say so. AI utility is being fluffed up to justify its progression. Yeah, I would say there. I mean, look at this thing. This is Amazon Web Services data center in Broadmoor, Oregon. I mean, I mean, look at that thing. That is massive. That's a million plus square foot data center buildings right there. Right there. I mean, these things are huge, huge. When you get in there, it's like so far down. It's like something. These things are cavernous. It's like something out of like the Lord of the Rings. When you're in there, I mean, they just look like they go on forever. Like you can't, like sometimes you can't see the end of it. I've been in a few of these buildings. They're like, yeah, they're insanely large. So, all right, and then going on here, so now a couple other wrinkles here. So China's new AI rivaled America's best, then ran short of computing power. So that's interesting. So its launch rattled U.S. chip stocks and revived a fear from the 2025 DeepSeek sell-off that cheaper Chinese models could erode America's costly AI lead. So what happened? So last week, a new Chinese artificial intelligence model called Kimi K3 outranked the most powerful systems from the United States on a widely watched coding test. Its arrival sent chip stocks tumbling in Asia and the United States. Day later, the company that built it could not keep the model running for new users. On July 19th, the Beijing-based startup Moonshot AI said it had paused new subscriptions to Kimi K3 because demand in the model's first 48 hours had pushed its computing power close to its limits. The step highlights a gap at the center of China's AI drive. Its firms can now build systems that match the world's best, but the U.S. controls have restricted their access to the advanced chips needed to run those systems at scale. Not really. Moonshot announced the pause in a message to users on X. But I would say the bigger issue, and let's see here, do they have, I thought there might have been, yeah, they talk about like a chip ceiling, whatever. Here's the bigger issue. The issue is not with the chips, because they've been getting the chips, because our good friends over there at NVIDIA have been selling these chips to China nonstop. They have, don't kid yourself for 1 minute. There's already been multiple investigations that China has gotten their chips through various different companies and routed around the world and everything, but they got them. That's the bottom line. The bottom line is that China got him. And Jensen Huang, he has made no bones about the fact that he wants to be able to sell anything and everything to China. He doesn't want any restrictions. He doesn't want anything. He's happy to hand them over everything they want, which is almost comical given to a guy who's so in love with Taiwan and loves his Taiwanese heritage. Just baffling. But anyway, all right. So this new Chinese AI company comes in. It kind of shocks everybody, but then they don't have the computing power. So again, now you kind of understand part of the rationale for like why the AI companies need these data centers. They got to have the data centers because they need the computing power, which is fine. But I also sit there and I say, well, how much is enough? And do you need all that right this minute? Like we already have more data centers than any country in the world combined. Like, and we've got, like I said, another 1,800 in the works. And these are not small data centers. These are massive data centers. And a lot of these numbers are being fluffed because a lot of this is stuff that I've talked about in the past. It gets back to that whole Silicon Valley mindset of just move fast and break things, move fast and break things. That is their whole mantra. It's their whole MO. It's what they're geared to do. It's like whoever gets there first wins. And basically what you're seeing with the insane pace of the build outs, the insane spending, is that they're basically all willing to push themselves on the verge of wrecking themselves in order to get there first. That's ultimately really what this comes down to, is that every one of these big players is willing to press themselves literally to the absolute breaking point to get there first, because they, in their mind, if they get there first, they win, and then they'll make tons of money, and then they can right the ship and they can do all this stuff. But the question is, do these guys destroy all themselves and destroy a big swath of our economy in the process? And when these guys blow up, do they come back to John Q. taxpayer looking for the bailout? That's the big question there. So, all right, continuing on here for a second. So then we get this other thing. Top American AI execs sound alarm on Chinese models. So on the one hand, like I said, they want to sell them all the chips. They want to sell China all the chips. They want to do all this stuff, but then they want to go back and cry to the White House when China makes a better, cheaper model than what they're putting out. So the White House is divided on how to respond to recent advances in Chinese AI, has weighed the crackdown on the measures. Now, this is also funny because now we're getting into this whole competition with China, right? This is like almost like a national security issue where it's like we have to beat China, right? Well, in this instance, it's pretty easy to beat China because right now we're building out the computing power. They have kind of built the China has built the power plants. So they've got more, and so they're ahead of us in the building of the power plants. So they kind of have more energy than us at the moment, but we have way more data centers at the moment. And so our problem is we need to basically build a lot more nuclear power plants to power these data centers and keep our electricity prices down. China's kind of ahead of us in that regard. They built a lot more power plants over there, but they also have a much larger population to service, and they don't have the infrastructure build out that we have. Also, I would say we have a little bit more control over the electronic supply chain in a certain regard as it comes to manufacturing of the key microchips that they need. Now again, China has come a long way in their manufacturing of microchips, but the U.S. and our partners we're still a little bit ahead of China. And we could make that real simple. You just simply go back and you just tell everybody, sorry, China gets nothing. They get nothing. They get the scraps. China gets the bare scraps. Okay. You tell Jensen Huang and all these guys, like, sorry, you're not selling nothing to China. I don't care. Like, I don't care about your bottom line. I don't care that you're gonna lose out on the sales segment. Don't really care. You're just, that, and that's how you beat China. It's real easy. It's not hard. You could you could push them back just enough that the US could stay 5 to 10 years ahead of them forever. And and it's but again, it's all these like half measures. And it's part of the problem here, right? So then we go on to um Scott Besson says that the U.S. could sanction Chinese AI developers over alleged model theft. So the Treasury Secretary said officials had found that U.S. model watermarks in Chinese systems and would examine the issue within days or weeks. Now, I mean, come on. Did you think that China wasn't going to steal? China's been stealing our stuff for the last 30 years, man. Like, you think they were going to suddenly stop? You think they were magically going to be like, oh, yeah, no, um, here's the bottom line: the Chinese are not innovative people. They're not. They're not innovative people, and it all comes back to the fact that they are a Chinese. That is the CCP. They are a communist regime. They do not have capitalism over there. They have what the state tells them to do. Now, the state might tell them, "Hey, we want you to build these chips. We want you to do this. We want you to do that." But the problem is there's no incentive. Like, look at I'm trying to think of the dude's name who built what was it, Tencent or oh gosh, I can't think of the name of that company over there. Alibaba. So the guy who built Alibaba, he, for about 5 seconds, he started thinking, oh, I'm like the tech bros of Silicon Valley. I built this multi-billion-dollar company. I made myself a billionaire. I could do what I want. And he started walking around like he was in charge. And he forgot that he forgot that he wasn't in charge. The CCB took him and locked him up in his house for, I think, what, like a year. It basically took it all away and basically said, dude, you don't understand. Like, you're not an entrepreneur. You didn't build this. You don't own this. Like, we own this. We own you, and you're going to do whatever we tell you to do. And you're going to shut up about it. Otherwise, we're going to snatch you out of your $100 million house, and we're going to stick you in prison and see how you like that. And then so he got the message. He got the message. He learned the lesson. And after like whatever, a year or so, they let him back out. And now he's back to running his company, but he's mining his P's and Q's again. And there's so therefore there's no they don't have the incentives over there like they do here. They don't, like, in other words, here, it's like you get rewarded for the coming up with things. Like, yes, it's the whole reason why Elon Musk came here to America, because it's like the land of opportunity. It's why everybody wants to come here, because we have this capitalist system. Now, of course, I can hear the detractors right now. People say, "Oh, what about this? What about crony capitalism and all the regulation, this other?" Yes, okay, all that's true. All that's true. But it does not change the fact that it's about what is engineered into our DNA. Americans have in their DNA a free, independent spirit. It's part of the DNA of what makes us what we are. The Chinese do not have that. That is not in their DNA. Okay, therefore they have to primarily get everything by stealing it. That's the whole name of the game. We got to steal it and copy it and buy it and copy it and plunder it and copy it. That's all they know how to do. That's all they know how to do. So again, like I said, if you just cut them off, you're going to stay ahead of them. It's not going to be a problem. It's not going to be a problem. All right, let's see here. Let's keep going here. So, White House advisor accuses Chinese AI of stealing from Anthropic. So, Michael Kratsios said large-scale covert industrial distillation aimed at stealing proprietary U.S. technology is unacceptable. So, yes, because he said that, I'm sure they're just going to stop. Yeah, hardly. Okay, and then we go to inside China's all-out push to catch up with American AI chips. Xi's confidant leads fevered effort for domestic alternatives to win AI race. Chinese AI companies warned that anyone who resisted using local chips was a traitor. So, yes, so here we go. So, last summer, top Chinese chip developer Huawei Technologies held a closed door briefing for the country's technology czar to introduce its latest artificial intelligence chips. The company laid out a plan for rivaling American behemoth NVIDIA and said China could become self sufficient in some critical areas of AI within 3 years. It was just what Zhang, a confidant of Chinese leader Xi Jinping, wanted to hear. So again, they say what they want to hear. Like, hey, Xi Jinping's like, hey, we got to beat America at chips. You need to do something. And this guy runs out and says, okay, we're doing this. Um, 3 years earlier, Washington had squeezed China's access to cutting edge AI chips and the tools required to manufacture them, a potentially crippling blow to the country's ambitions as a tech power. With Xi's blessing, Vice Premier Ding started a fevered effort to forge domestic alternatives. Ding dusted off the same all-out approach China had used to produce its first atomic bombs, hydrogen bombs, and satellites in the 1960s during a rift with the Soviet Union. He set up a committee that drew from the country's best companies and labs to form specialized teams and directed them to master the different elements of the chip supply chain. Hawaii's report on its progress gave Ding leeway to be more aggressive. He delivered a blunt warning to China's largest AI users, according to people familiar with the message. Anyone who resisted employing domestic chips was a traitor and would be locked up, arrested, maybe even shot. Who knows? But again, this gets back to my whole point. This is what they do. Now, there is a book that I covered that I did a research report on. It was called Chip War. I would highly encourage everyone to go read that book. Chip War. It's the history of Silicon Valley. It's the history of the creation, development of microchips. Basically the technology race, if as it were, and that book does a great job of talking about the space race between the U.S. and Russia, the technology race between the U.S. and Russia, and explains exactly why the U.S. won that race and why Russia fell so far behind. And what they leave out here is that they got in this argument with Russia during the 1960s, right? They ended up with this rift with the Soviet Union. And part of the reason was because even then, by the end of the 1960s, the Soviets were already starting to fall behind us in terms of their production, their technology, and where they were going. I mean, they got that boost initially in the 50s, but then it wore off because once we put all of our might into saying, okay, we need to develop in this area. Okay, we didn't tell people that if they don't do this, they're traitors, and we're going to lock them up. This is what we do. We say, hey, this is an industry. We need to go after this. And then everybody puts all their brain power into, okay, how can we figure this out? How can we make a better widget? How can we do this? The part that they left out of this article here was the fact that part of the reason why the Soviets weren't sharing was because they didn't have anything to share. Okay. They were already falling behind. And then the other thing was that the 1960s, China tried to set up, they tried to do all this. Remember, how far did they get? Did they get very far? No, they didn't get far at all. So he kind of forgets that. He leaves that critical part of the story out here. But so again, China's trying to play this catch up. They're trying to get supply, they're trying to work the supply chains. They're trying to get they're finding every way to get, trying to get NVIDIA chips so they could copy them and then try to come out with their own chips. So again, so it's interesting to note. It's just interesting to note, like, here's what is going on, here's what they're doing. Let's see here. And then OpenAI says its model autonomously hacked Hugging Face. OpenAI said the autonomous model penetrated Hugging Face's servers while searching for secret information that could help them pass an evaluation. Now, this was kind of scary. So OpenAI, the company that makes the ChatGPT chatbot, had revealed that its artificial intelligence models autonomously breached another company's production system in what it called an unprecedented cyber incident. The ChatGPT maker said in a July 21st blog post that the models, including its newly released GPT 5.6 Soul and a more capable model still undergoing internal testing, comprised infrastructure operated by the AI platform Hugging Face after escaping a restricted environment in which a cybersecurity evaluation was being conducted. The model searched for and successfully found ways to gain access to secret information it could use to cheat the evaluation. In one case, the model assembled multiple attack vectors into a single cyberstrike, cobbling together stolen credentials with zero-day vulnerabilities on the Hugging Face servers before exploiting a remote code execution path to carry out a breach. We consider this incident to be an unprecedented cyber incident involving state-of-the-art cyber capabilities and are responding accordingly. Yeah, so it's wild. This is a wild story. Basically, what I read elsewhere outside of the story was that basically the OpenAI program went out to the internet, looked up a bunch of stuff, found a way to get into Hugging Face, then went to Hugging Face's website, broke into that, got in there, got a whole bunch of information, brought it back, and then basically was like, "Yeah, here's how we can do X, Y, and Z." I mean, it's pretty, and it was not told to do any of this. It did it all on its own, which is highly disturbing. Then we go into now, this was really interesting. So, a judge approves a 1.5 billion settlement in Anthropic copyright case. If the case had gone to trial, the company would have been liable for tens of billions in damages. So, this is very interesting. So, a federal judge in San Francisco on July 21st approved a $1.5 billion settlement in a copyright lawsuit against AI giant Anthropic by a group of authors that alleged the company used pirated copies of their books to train its AI model Claude. We reached this settlement in 2025 after the court's landmark ruling that training AI on books is fair use under copyright law, which remains the law today. Anthropic attorney Para Sridhar said in a statement. She added that the company was looking forward to bringing this matter to a close. U.S. District Judge, however, issued a ruling approving the settlement, the largest of its kind in U.S. history. The judge dismissed objections from some plaintiffs that the amount was too small, saying those claims didn't reflect a realistic assessment of the overall risks and rewards of a trial. But she also refused to grant the plaintiff's attorney the full amount of fees they requested. They wanted more than 180 million, but she granted $100 million basically. If Anthropic had lost at trial, the judge could have imposed a penalty of up to 150,000 per violation under U.S. copyright law. Since the judge admitted more than 480,000 books as part of the plaintiff's claim, the potential award could potentially have cost Anthropic tens of billions of dollars. Some plaintiffs opted out of the settlement ahead of time and filed separate lawsuits. The judge on Tuesday rejected opt-out requests from several others who made the request too late, but she allowed two other plaintiffs to exit the settlement due to extenuating circumstances. In one case, an author was not notified of the settlement in time, and in another, the plaintiff was recovering from a stroke. Anthropic intentionally downloaded known pirated copies of books from the internet, made unlicensed copies of them, and then used those unlicensed copies to digest and analyze the copyrighted expression, all for its own commercial gain, the author's 2024 complaint said. So yeah, so I think this is really interesting that this came down. Didn't hear a lot about this. This did not make big headlines or anything like that, but and like I said, I am really surprised that a lot of other companies have not sued, like OpenAI and Anthropic, um, going after them for copyright. I mean, there's no doubt that they have taken a lot of intellectual property and used it to train their models and done a lot of different things with it. So, again, I'm really surprised here. And given the results of this, I wouldn't be surprised to see more lawsuits follow on beyond this. So, okay. Now, so let me just go back before I get into this private equity thing here for just a second. I want to go back for a minute And I just want to just to kind of recap the AI thing, because there was a lot there was a lot there, right? There was a lot to go over with some of this stuff. So again, because again, some of this is kind of convoluted because it's a lot of back and forth. It's like we're competing with China, but yet we're letting them buy stuff, and we're kind of playing this cat and mouse game. They're stealing a bunch of stuff. Why we're not really coming back down hard on them and on the companies that they're supplying what they need, like Nvidia, beyond me. Um, but then also we've got the data center build out, which has become a big problem. We've got the spending from AI companies, which is a big problem. And here's the other thing. Jensen Huang, he wants to sell chips to China, but then China uses that to make cheaper, faster, better models. And then the models come on there, and then the tech bros freak out. Anthropic, OpenAI, they freak out and then run back to the White House and say, "Yo, we want you to do something about this because we can't have them beating us to the punch." And like I said, it's just the whole thing is just it's crazy. The whole it's just kind of crazy. Um, like I said, you understand why we need the electric capacity, why we need the data centers, we need the computing power, why we need the AI, because we do need to stay in front of China. But then we see things like what like I said, you can't do this with no. We see this about like what's going on here with OpenAI. Like I've said this before, you have to put guardrails around this. You can't just let, I mean, these guys have treated this clown here and these other guys have treated the AI like the Wild West. They've treated it like the Wild West. And, these frontier models I mean, they could cause immense damage. And there just has to be guardrails around this. There has to be. They cannot let these guys just run wild doing whatever they want to do. It's just yeah, so again, I know that's not like the greatest recap of all time on the AI thing here, but I'm just trying to put some of this a little bit more back into focus and in context. And when I say the AI trade is in trouble, it is in trouble because they're spending this insane amount of money to build out all these data centers, this AI capital expenditures, and the AI is coming along, but it has not delivered yet on this great promise. It has not delivered on it yet, and they're running the risk of China coming out with cheaper models. You already have companies that have blown through their AI budgets, and now they're like, well, we still need AI. Well, let's go to that cheaper Chinese tech, and that's scaring them to death because they don't want the companies to go to the cheaper Chinese tech. So this whole thing is beginning to, you could see the cracks in this. You see the cracks in this, and if this blows up before AI is really able to deliver on this promise, yeah, that's a big problem. So anyway, all right, let me go back. I want to run through just a couple of things here. So this, because I don't want to wrap up here in a few minutes. Private equity assets stuck in zombie funds are at a record high. So funds are outliving their intended lifespan as fund managers struggle to sell the remaining assets. Now, I had reported on a few months ago that in private equity world, there's this giant backlog of companies. Private equity, they usually like to have a company for like 5 to 7 years and then unload it, make their profits, go on to the next thing. Well, they have got thousands of companies now in this backlog. You can see net asset value in U.S. private equity buyout funds, 7 years and older. You have 7 to 9 years now, and then you have 10 plus years. And you could see like the amount of assets and the number of companies is now into the thousands. So private equity has built this whole ecosystem of just gobbling up all these companies, and now they've got this massive backlog. But the key to their business is being able to unload these companies. And if they can't unload the companies, not to say that the whole model breaks, but they're going to have to figure out plan B here pretty soon, because this is just not going in the right direction. And some of these companies are gonna stall out. All right, let's look at Z for just a couple, for just a second here. So a couple articles here. It's no great resignation, but here's why turnover risks are back on the rise. So Robert Half found 46% of American professionals plan to seek new jobs in the second half of 2026. Gen Z workers lead job search intent at 55%, citing better benefits, career growth, and flexibility. Layoffs and cost cutting is sparking uncertainty among many workers. Then we go into, could the average millennial retire a millionaire? Vanguard's new numbers offer a clue. So, Vanguard data shows the typical millennial retirement balances are still modest, but time and steady savings could put 1 million within reach. Under our estimates, a 30-year-old millennial could reach 1 million by age 65 at a 10% total contribution rate. A 40-year-old millennial may need a total contribution rate closer to 15% to reach 1 million by 65. Now, that sounds good. And $1 million is certainly better than nothing, right? That's not bad. But is $1 million what it used to be? No, not necessarily. And I think this says in here, and it gives like average, what are like the average savings about, account balances, whatever. But I'm trying to think if it's in here or if it's in the other article. It might be in the other article. I'm just trying to see like average, and they're giving like average balances here. But I was trying to see like like if you think of like a payout, right? Like if you have $1 million and you make a return on that money and you take a payout, so you take so say you're gonna draw probably about $40,000 a year, from that, right? And then say you get another 20 or 30 grand from Social Security. So you have basically $70,000 a year, right? And you think about like, well, what's the lifestyle that I'm living today? Like, so say your lifestyle is based on making, I don't know, 150,000 a year, right? And now you're down to 70. Well, I hope you've paid off all your debt, because it's going to be very difficult for you to go from living on 150 to $70,000 a year, if you still have a lot of debt by the time you're 65, 70 years old. So that's one of the flaws there. And then basically, and the other issue here is earnings power, like just earnings, like in other words, like $1 million today is not what $1 million was in 1990 or 1980 or 1970. And this is my point exactly, like a $100,000 salary is no longer the standard it once was. Here's the new number. So Americans now consider 270,000 the average successful salary, up from $100,000. So $100,000 salary requires $183,000 today to match 2,000 purchasing power. So new college graduates expect 100,000 starting salaries, but average $68,000. So again, so it's the purchasing power of the dollar. Again, people used to think, oh yeah, you have $100,000 salary, you have $1 million in savings. That's not going to get you there, and that's what this data and that's what this kind of survey results are telling you, that people are now saying, oh, it's not 100,000 anymore, it's 270,000. You got to make 270,000. What's another? Let me ask you another question. What's another problem with making $270,000 a year? Oh, well, that's right. The government considers you a multimillionaire if you make over 200,000 a year or 220,000 a year. The government thinks you're Elon Musk, and that you should be taxed accordingly for that. Yeah. Then we go into ChatGPT's new finance features let users link accounts, but experts raise privacy red flags. Yes. Oh, yes. What is this here? Some ChatGPT users can now link financial accounts through Plaid for personalized budgeting and spending insights. Experts say users should never share passwords, social security numbers, tax documents, or other highly sensitive data with AI chatbots. Linking accounts may resemble a budgeting app, but experts warn that conversational AI can make users more likely to overshare. Yes, and then that AI is sucking all that data up, sucking every ounce of data it could get its hands on, and Lord knows what it's doing with it. But yes, you should be very careful before you start doing this. I personally, um, I see the benefit. Like I'm thinking of something like Mint or Quicken, where and there's been some other platforms out there over the years that have allowed you, like, you could put all your finances in one place, link them all together, and yeah, and then I'm sure it could give you some great data. It gives you, oh, here's your net worth. Here's a whole bunch of charts analyzing your assets and liabilities, and looking at your debt and all this other stuff. I'm sure they could give you a whole lot of really good data and tell you, like, you're on track, this and that. Maybe say, hey, yeah, you need to increase savings over here, do this, do that. I just see a major danger and sharing all of your personal financial information like that, sharing all of that now. And again, and I will preface it by saying there's a major difference from being, 25 years old versus being 50 years old. Your financial life is going to be completely different. And when you're 25 and you're like, oh yeah, okay, I got a checking account, a savings account, maybe I got a little stock trading account, whatever. Okay, when you're 50 and it's like, okay, I've got a house, maybe it's like, I got a house, I got a business, I got a retirement accounts, I got investment accounts, I got all kinds of accounts all over the place. Then, all of a sudden it's like, well, wait a minute, do I want to put all that information in one place, that if there's some kind of data hack or something one day, that somebody could basically get all of my information, to everything, to all my accounts, access to all my accounts, know where all my everything I own is? Like, yeah, that's a major risk. Like, you don't want to do that. You do not you do not want to do that. So just, something to think about there. But just in the context of this conversation, I just wanted to point out that, that basically that some people will be on the move. Job searchers, that again, the job market is relatively stable. Some of these job users are going to be on the move the second half of the year here. Gen Z is primarily looking to move. And then looking at millennials, again, you're going to have to change some of your thinking around, savings for retirement. What's a sufficient amount you need? I would say for a lot of people to have the kind of lifestyle they want in retirement, you're going to have to save a minimum of somewhere between $2 to $3 million. Like, that's basically the key number that you're going to need, just to keep up with inflation, to keep up with taxes, to keep up with medical expenses, to keep up with all of these things. That's really the number we're going to need to be at. The problem is that very few people actually get to that. Like, I'll have to find. There's another great article I saw that basically pointed out, like, how many people actually get to $1 million in their 401ks. It is a very small number of people. It's like 2% of people actually get to $1 million or more in their 401k. So again, that is an issue, and you see it in every generation, whether it's boomer, Gen X, millennial. They're all behind in retirement savings, all massively behind in retirement savings. So like I said, I just and again, the question gets back to, what is the value of a dollar? You know what I mean? And 100,000 isn't the thing. It's 270,000 now. How many people are actually have a job making 270,000? Not that many. Not, I mean, there's probably more than you think, but also less than you think at the same time. So, all right. A couple other things here, real quick. So, SBA unveils new grant program for small businesses aimed at supply chains. So, the Small Business Administration launched the SCALE program, offering 20 grants up to 500,000 each. The SBA doubled combined loan limits up to 10 million for small businesses effective July 4th, and the agency established the Faith Office and Office of Rural Affairs on June 5th. So, okay, so we'll keep an eye on that. Let's see here. What are some other things I'm keeping an eye on here? So, okay, so Wall Street firms are paying 100,000 a month for a fast track to Trump's post. So I mentioned this at the beginning of the program tonight. Traders who already monitor the president's pronouncements with automated systems can pay for an ultra fast feed. At least 5 firms have signed up. at $100,000 a month. So wow, that's unbelievable. So this is like, we'll keep an eye on that. I also want to keep an eye on this. Trump's taking on right to repair, and what does that mean? Massachusetts and Maine are the only two states that currently have comprehensive right to repair laws for car owners. This is your right to be able to repair the vehicle that you own. Um, and like I said, I'll have to get into a much more deeper conversation on this on a later point in time. So, and then let's see here. What else do we have? Paramount agrees to delay Warner Brothers Discovery buyout for months. Federal judge approved the hold until trial or June 2027 as 12 states and the Writers Guild advance antitrust fight. Man, they really do not want the powers that be do not want Paramount to buy Warner Brothers. Man, they do not. They just do not like that. Do not like that. And then this is kind of, we end this on a kind of a funny note. So the House passes congressional stock trading ban. It now goes to the Senate where its prospects are uncertain. In other words, that's called DOA, dead on arrival. Yeah, I always say this. They will always do these gimmicky things to make it look like, oh, we're doing something and we're going to rein ourselves, we're policing ourselves, we're going to rein ourselves in. These things, they never go anywhere. This will go nowhere. I guarantee you, this thing dies in the Senate. It is a 0.0000% chance of this getting passed. So, but anyway, all right, I'm going to go into wrap up mode here real quick. I'm going to get up my story of the week and my quote of the week. But before I go into that, I just want to do my items. Let me get my banners up here. So, okay. If you are watching the podcast on Apple, Spotify, or I'm sorry, on Apple Podcasts or Spotify, please make sure to leave me please make sure to leave reviews, as that will really, really help the channel. I would really appreciate it. So again, if you're out there listening on Apple Podcasts or Spotify, please make sure to leave me a review, as that would really, really help the channel. Remember to visit the website, thebankernextdoor.com. A lot of great things on the website, a lot of things coming to the website pretty soon. Make sure to subscribe on YouTube to get all the latest announcements via posts that I'm putting up stuff every single week. Send your comments, questions, or topic recommendations to info@thebankernextdoor.com. That's how you get in touch with me. info@thebankernextdoor.com. You can also follow me on social media. I am up on Getter X and Truth Social, although I will tell you I spend the most of my time on X. So, and remember, BND is on YouTube, Rumble, and all major podcast platforms. We have new episodes every week, Monday through Friday, premiering at noon. And the BND Strategy Room is every Saturday night live here on YouTube at 8 p.m. So, okay, that being said, let's get to our story of the week. So, July 22nd, 1944, the Bretton Woods Agreement was reached in Mount Washington, New Hampshire, pegging major foreign currencies to the US dollar, fixing the gold price at $35 per ounce, and laying the groundwork for the International Monetary Fund and the World Bank. So the Bretton Woods Agreement. A great book that you can read on the topic of Bretton Woods is called The Battle at Bretton Woods, which was a phenomenal book. I would really like to get to that one day. But you had a couple of major things in the 20th century. Three major events happened. 1913, you have the creation of the Federal Reserve, and you have the creation of income tax. Okay, both in 1913. So the creation of the central bank changed the game. Then in 1944, you had the Bretton Woods Agreement. Again, coming out of World War II, it was basically the new world order of the elevation of the US dollar to the world reserve currency, making the US the dominant financial and military power in the world. That's really what the Bretton Woods Agreement, the Bretton Woods gathering there, that's what it established. That's what it was there to do. Basically set up, okay, how is the US going to economically dominate the world after World War II? That's why it was such a profound and fundamental meeting and event. And then the third thing you had was 1971, basically Richard Nixon taking the US off the gold standard. And there's a great book on that called, I think it's called 3 Days at Camp David. if you want to learn about Nixon's decision to take us off the gold standard. But those three major monumental events in U.S. history in the 20th century that basically changed the future of the United States. So again, economically changing the future of the United States. So that is our story of the week there, the Bretton Woods Agreement from July 22nd, 1944. So, okay, now I will shift gears and go to our quote of the week. So this comes to us from Sun Tzu, from his incredible book, The Art of War. And it goes like this: He who knows when he can fight and when he cannot will be victorious. So think about that one a little bit. He who knows when he could fight and when he cannot will be victorious. Yes, Sun Tzu believed that 90% of all wars were fought. Wait for it, before you set foot on the battlefield, not after, before. Think about that. So if you've never had a chance to look at The Art of War, I highly recommend checking it out. You will learn a tremendous amount. It's kind of very interesting. Over in Asian cultures, in China, Japan, you know, Taiwan, all these different places, they actually study the art of war as part of what they consider business training. Even though it's military tactics, they apply that to the business world. They view business as war. It is warfare, and you have to understand that mentality on the part of a lot of the Asian countries, whether they be our partners or whether they be China. So, they a lot of times they view business as war, and again, and that's why they look to a lot of things. A lot of their students have to read Sun Tzu, have to study the art of war, and really dig into that. So, all right. That's all I got for this week. I thank you for hanging out with me here on a Saturday night. I hope everybody enjoys the rest of the weekend. Have a great week out there. And I thank you so much for being here in the strategy room with me. Take care, everybody. And I will see you again next week.